Some of them might be surprising for some of us, but we wait to see how they will be applied and the effect of those. I think the key one in my mind is the introduction of the 10% tax withholding basis on the retained earnings. So basically what you are seeing here is the proposal to deem the retained earnings as distributed. A percentage that would have been applied in the past on the dividends once you declare and pay them now will be applied to your retained earnings if they are distributed in a period of 6 months. I think this follows a decision which went against the tax man in the recent past on deeming those retained earnings as distributed, and what the tax man is essentially doing is really to just amend the law to capture taxes from that angle. That might have implication in terms of the what the investors would want to retain in the economy, and might, as we closely watch, might impact the level of investments in the country. We have seen other changes, including the alternative minimum taxes being increased from the rate of 0.5% for loss-making entities from tax standpoint to 1%. So we remain to watch as well on what that means for entities that continue to invest and are in the loss-making position. Certain exemptions have come through from VAT perspective, especially on the agriculture sector. So for example, exemptions on pesticide and tractor tires, aiming to improve the sector, which has been the biggest contributor to the GDP and involves majority of our citizens in terms of economic activity. And many other changes come through. I think from administrative side, we'll be seeing the taxman requiring corporate and entities invoicing systems to be integrated or interfaced with the TRA system. That can come with its own teething issues that we need to watch as well as the activity continues in many of our organizations to ensure that the business disruption doesn't occur because of issues that might happen from the taxman side system. We have seen from the local municipal authority perspective, the city service levy that we used to have, that has been reduced from the traditional historical rate of 0.3% to 0.25%. I think 0.05 reduction, if you like. Now, we will see many other changes. What I wanted to tell you today is be ready to engage. We want to make this session of 3 hours very engaging. We want to see as many questions from you. Whatever we'll be able to capture in this forum, we'll capture. Anything that we might need to do a follow-up, our experts and teams are here to pick those up with you. But we have also gathered a very interesting panel of business leaders who will be engaging with us to ensure that we are able to dissect some details there. And from this point, I would want to welcome Professor Dr. Donald to just come in and give us economic analysis that we would want to see to lay a foundation for our discussion today. Thank you very much, and you are welcome to engage. Thank you. Professor, continue.
Dr. Murray, if you're speaking on mute, we cannot hear you. All right. So while Dr. Murray is aligning to come and give us the economic overview, we will go ahead and start the discussion on the proposed tax changes that have been brought about with the budget for the year 25-26. And for that, I'll be welcoming my colleague Benedict Kombaha, who is a tax manager at KPMG. He's going to take us through the proposed tax changes and what that actually means for the businesses in Tanzania. Benedict, karibu.
Thank you so much, Cecilia. As Cecilia said, I'm the tax manager with KPMG practice in Tanzania, and I'll be taking you through the proposed tax amendment in the context of value-added tax, excise duty, Tax Administration Act, and any other relevant regulatory amendment. So, commencing on the proposed tax amendment in the context of the VAT, if you are to categorize the proposed amendment, then you will likely discern that the proposed amendment earmarked it to achieve the following. One is to ensure the agriculture sector is promoted, and this is on the basis that agriculture sector is a leading contributor to the GDP that we had attained in the preceding year. We as agriculture had contributed 26%. So I think the essence of the proposed VAT amendment to ensure that contribution continues to be amplified. The other one, I think, is to ensure there is protection of local market, and I think this has been necessitated by the policy shift that we have seen, specifically from the developed country, in terms of the tariffs that have been imposed from their end. The other one has been to ensure that there is some sort of cost relief to the business environment, which essentially is to ensure there is a good business environment that can actually attract investors in Tanzania. And I think the other one has been to just protect government revenue in a way that is mostly common to everyone, widening the tax base. And I think the other sought outcome has been to just champion the use of clean energy. This can be in terms of cooking clean energy, and also can be in terms of adoption of the use of compressed natural gas and liquefied natural gas. So to go now on the specific, among the proposed amendment include one, VAT exemptions on pesticides. I think this is essentially aiming to provide tax relief to the farmers, and then in the end champion agriculture growth in the country. The other one has been VAT exemption on reinsurance transaction. I think VAT for insurance business has been a pain point since its inception. And even if you go and have a look at the number of cases that are pending before the appellate machinery in terms of tax revenue appeal board, tax revenue appeal tribunal, in the precipice of insurance business, most of them emanating or attributed to the VAT. So now the government has proposed to exempt VAT, specifically on the insurance transaction. This is insurance transaction between insurance company and the insurance company. So the expectation here is for VAT now to be exempted in terms of the premiums that will be paid to the insurers, and also in terms of the proceed that will be emanating from the insurers to insurance company. So we believe this might be a step in the right direction, specifically in terms of addressing the VAT challenges that has been prevailing in the context of insurance business. Now, the other proposed change has been the rating textile products. I think this is essentially to just protect the local market and ensure that the policy shift that are happening all over the world are not having any unprecedented effect on our market. Also, the other proposed change Yes. The other proposed change has been zeroing locally produced fertilizer. So for the past 3 years, the government has been zeroing locally produced fertilizers for the period of 1 year. But now the government has gone a big step and said that they are proposing to zero rate, but for the period of 3 years. So the essence here is to continue boosting the agriculture sector and ensure that there is cost relief to the farmers. Similarly, there is a proposed amendment on VAT exemption and on edible oil. This is also an extension. It has also been provided in the past 2 or 3 years for the period of 1 year, and now it has also been proposed to be extended for a further period of 1 year. The other proposed amendment has been repealing VAT exemption on gaming supplies. This is in terms of purchases and importation. And I think here the essence is just to ensure there is a protection of government revenue, that is widening tax base, and also to attain the principle of equity in taxation, because as a sport relating activities within the VAT regime, so it was not equitably fair for gaming supplies or gaming activities to be VAT exempted. Yeah, the other proposed amendment is on tractors, tires, dam liners, forks, rakes, and axes. I think this is essentially still to promote agriculture activities in the country. And I think now one among the ambiguously proposed amendment in terms of the VAT has been the proposed introduction of what it is called the VAT collection agent system, whereby specified government ministries like Ministry for Finance and the other government-related institution will be tasked with the duty of acting as a collection agent in terms of collecting 3% of the VAT that is earmarked to go to the registered sellers. So there is a lot of ambiguity here, specifically in terms of if that amount is collected, then what happens to the output tax that is to be reported by the seller? And also, how will it be practical? I mean, in terms of practicality, how will it prevail? But there is a sense of hope, as the budget has said, there will be requisite regulations that will be issued to put some sort of clarity. But our thoughts or our expectation is for it to be marred with some practicality challenges, especially in terms of its execution. And also the other proposed challenge has been to exempt locally published newspapers from the VAT. And I think the essence is to instigate cost relief to the consumers and producers, and in the end prompts accessibility of news by a large chunk of the citizen. Yeah, and now the other proposed change, as I've said, in the context of VAT, earmarked in terms of championing clean energy use. For instance, you have seen a number of VAT exemptions that have been proposed in the context of natural gas that will be sold to compressed natural gas stations, specifically for motor vehicles. We have also seen the government going an extra step to ensure there is a clarity for VAT exemption in the context of liquefied natural gas and compressed natural gas. And also there are a number of proposed VAT exemptions on cooking gas tanks and cylinders and decarbonization fuels, with the expectation that the proposed VAT exemption would drive the adoption of clean energy use in Tanzania. Okay, so this slide also just covers what I was saying in terms of the proposed VAT amendment pushing for the adoption of clean energy use in Tanzania. Yeah, I think the other proposed amendment, which are now earmarked to protect government revenue or widen tax base, has been one. To expand technical interpretation for online intermediation services. So since this is essentially trying to now bring into TaxNet the non-resident service providers, who are somehow providing electronic services, but they are not captured in the technical interpretation for online intermediation service. And this was actually seen in a number of disputes that were prevailing between these non-resident and the tax revenue authority, where tax revenue authority would send them a notification telling them they're eligible for VAT registration in Tanzania, but those non-resident service providers will challenge that assertion on the basis that if they are to look at the technical interpretation of online intermediation service, they are not actually covered. But now the government has gone a step further and expand the technical interpretation for online intermediation service to ensure that it brings into TaxNet more of these non-resident service providers who were somehow left out from the auspices of the technical interpretation that has been there in the past. And now, similar to that, has been also to bring into TaxNet the online financial intermediaries. These are online payment platform maintained by the non-resident service provider. So the same here, the essence here is the same, to widen the tax base and bring into TaxNet this non-resident service providers who are providing this kind of services. And I think now the other interesting part has been on a revised VAT regime, specifically for online purchased goods. I think here the essence is to promote cashless economy, because a flood of reports has been said among the biggest cause of revenue leakage to the government has been the essence of our economy being more cash-based. So now, if we can have a cashless economy, then there is a high chance of us addressing the revenue leakage that are prevailing in the country. And I think now the essence of proposing this revised VAT regime, where now if you are to purchase goods online and you make that payment online, then the VAT that will be charged on that good will not be a normal 18%, it will be a 16%. So that means for anyone who will be opting to purchase goods online, they'll likely be having a cost relief of almost 2%. And in the end, the expectation is to that now major part of the citizens will be opting for these online based purchases, a cashless economy, rather than doing a cash-based transaction. Yeah, so in essence, that's all proposed amendment in the context of the VAT. Now coming on excise duty, if you are to analyze the proposed amendment, then it is apparent that the amendments are trying to achieve, one, to ensure our excise duty regime is predictable and as stable, that is, to ensure there is predictability and stability in the excise duty regime. The other one is to ensure there is a cost relief to manufacturers and importers of excisable goods, which in the end will prompt improvement of business environment in the country. The other one is to ensure there is a protection of local market, as I have said earlier, to address the policy shift that are happening in developed countries. The other one has been to address or to promote environmental conservation approaches. And the other one is the normal, to just widen or to protect the government revenue. So specifically, the government has reiterated its stance to continue to freeze inflationary adjustment on excise duty, specifically on non-petroleum products, to a 3-year period. So previously, every year, the government was adjusting inflationary prospects on excise duty. That means every year you will be expecting a change in excise duty, specifically for non-petroleum products. But now with the reiteration that the government will still continue to adopt a 3-year freeze on inflationary adjustment, that means we likely have a predictable and stable excise duty regime. I think the other one has been to discard or to scrap off licensing fee, which was almost 300,000, which was imposed to manufacturers and importers of accessible goods. So the essence here is to promote cost relief to these manufacturers and importers, and in the end, improve the business environment in the country. And now the other one has been revised, excise duty on undenatured ethyl alcohol. So this has been a downward revision in terms of excise duty that was prevailing in the past, specifically for imported and locally manufactured ethyl alcohol. Yeah, the other one has also been revised excise duty on locally manufactured energy drinks. And the essence now is to just prompt the protection of local market and ensure that the citizens are more geared toward consuming locally manufactured products. Also, I think the other one has been introduction of excise duty on foods that are deemed as unhealthy foods. So the essence here is just to try to instigate a more healthier food consumption among the citizens. So we are seeing introduction of excise duty, for instance, on crisps. This will be both imported and locally manufactured. We are seeing introduction of excise duty on ice cream and other edible ice. So the essence here is just to ensure that how to promote a healthier living style in terms of the food that is being consumed by the citizen. Yeah, so similarly, introduction of excise duty on sausage and similar product is also aiming to just attain a similar outcome, which is promoting healthier living standard or habits to the citizenry. And also, we are now, the government has proposed to introduce excise duty on imported soap. So this is essentially to just protect the local market and push the resident toward adopting or consuming more of the locally manufactured products, similarly to the introduced excise duty on imported matches. Yeah, so similarly to imported margarine, this is just essentially trying to promote healthier living approach. And I think the other one has been now introduction of a carbon-based excise duty, specifically in terms of carbon emission arising from coal and other related items. So the essence here is just to ensure we curb negative environmental prospects that are coming from the emission of carbon-based activity. So the excise duty that will be introduced, which will be measured in terms of per metric ton of the carbon that will be produced, is essentially expected to address the hazardous environmental practices that are adopted by the businesses in the country. And I think the other one has just been introduction of excise duty. This is for other providers of money transfer and payment system, which are not banking on the traditional financial telecommunication modalities to facilitate that kind of payment. I think essentially here they are trying to widen the tax base and bring into TaxNet the money providers who are not banking on the traditional financial and telecommunication modalities to provide those kind of services. I think it might be like ASAM. I think we have what we call ASAM money, which is not a traditional payment mechanism. Yeah, so now I will move to other notable changes. I think on tax administration, Alex had preempt on what the government is proposing as of the budget. As of the tabled budget speech, there are only two major proposed change. One is with the effect of trying to discard 15 days waiver application requirement. But I think we have to caution here, because if you are to look at the way the words have been construed in the budget, in the proposed budget speech, then there is some sort of ambiguity in terms of what is it that the government is trying to achieve with respect to this proposed amendment. But we think what the government is trying or is actually trying to achieve, and this might be ascertained by the finance bill that will be rolled out, is to just remove the requirement whereby if you are to apply for waiver of making a tax deposit, you have to do that within the initial 15 days from the date of receiving the tax decision. That means if that 15 days lapse, then you have actually waived or you have actually infringed your right to apply for that waiver. So I think now they're just trying to ensure that taxpayers have a right to apply for that waiver of making a tax deposit through the required period of lodging the objection. That is within the period of 30 days from the receipt of tax decision. You will still have a right to apply and request for waiver of making a tax deposit. Yeah, and I think the other one is on integration of taxpayers invoicing system with the TRA system, as Alex had said earlier. But now the expectation is that if that integration has to be successful, then it should also curb the prevailing challenge that we have seen happening with respect to modified EFDMS system, because you might find that the client just, if they look at their pre-populated sales data and the VAT return, it normally does not align with what they have as per the fiscalized item. And then they are just forced to just continue either paying based on what they have on their working, or and then proceed to object the assessment that has been generated in the system. And the challenge is they normally don't have the base of what is making the figure that is pre-populated in the VAT return system. But now the expectation, if this interface happens and proves to be successful, then taxpayers can even have a look in terms of what is it that the TRI system is actually depicting in terms of their sales figure for the respective period. Yeah, I think the other one has been a downward revision of service levy from 0.3% to 0.25%, and also a downward revision of weighted levy from a prevailing 10% to 2%. So the essence here is just to provide cost relief to business environment, and also to implement the blueprint for regulatory reforms to enhance investment and business attraction in the country. Yeah, and also the other one is the insurance, the proposed amendment to the Insurance Act, where now there is a proposal to introduce a mandatory travel insurance for foreigners that are entering the country. And I think the essence is to cover those foreigners against unprecedented prevalence of events, for instance, health-related emergencies, baggage delays, theft, accident, and also to cover repatriation expenses in terms or in case repatriation need occurs. And I think here the travel insurance will be applied to foreigners with the exception of those coming from this East Africa community and those coming from SADC. And also the travel insurance will only be limited to 92 days. Then that means after the lapse of 92 days, the paid travel insurance will be irrelevant. And also this will now be achieved through the interplay between government, National Insurance Corporation, and the other insurers in the country. Yeah, and I think the other one has been a revised contribution modality to the consolidated fund. I think if you are making follow-up to what was happening in the country, specifically in the past 2 to 3 days, where the Honorable President Samia Suluhu was receiving contribution from the public related entities, they had earmarked a significant improvement in terms of non-tax revenue that has been collected, which was almost amounting to 1.03 trillion. And this now, the non-tax revenue, specifically from public-related entities, emanates from dividends that are normally paid by these entities, public entities or entities that government has a stake in, and also there is what we call contribution to the consolidated fund. So previously, there are some eligible entities who were supposed to be making a contribution to the consolidated fund, which was calculated on a fixed 15% of the gross revenue that you are reporting, and it was supposed to be paid on a quarterly basis. But now the government has revised that modality to the extent it will no longer be on a fixed basis, but it will be on a varying rate ranging from 15 to 60% of the gross revenue, and it will be paid on a monthly basis. I think the essence here, what the government is trying to achieve is to improve the non-tax revenue collection prospect and reduce the reliance on tax revenue and borrowings to finance the budget. But the other challenge that has been prevailing in the context of contribution to the consolidated fund is in terms of deductibility of this amount, because now the public related entities were complaining that they are making this contribution, but in the end they also have to pay a certain percent tax on them as they don't qualify for deductibility in terms of income tax prospect. In the Finance Act for prior year, in the Finance Bill in the prior year, the government had proposed to now allow deduction on a contribution that will be made to consolidated fund, but the same proposal was not endorsed in the Finance Act. So as much as now the contribution modality has been revised, a huge point of interest to be on whether the government will then revisit deductibility provisions on this and allow it, or will still continue to maintain the same practice, which is to deduct, to restrict its deductibility. And in essence, this might prove to be some sort of increasing the burden to the public head entities. Yeah, and I think the other notable change that we should all be aware is now propose or to revoke BRELA powers to close business in the country, especially when there is an alleged breach of the terms of the Act, which is Business Licensing Act. So in the past, BRELA was mandated to close business in the country, especially when they believe that certain provision of the Business Licensing Act were breached. And I think this led to a string of complaints from the business fraternity in the country, as we are saying that practice was discouraging investment and business growth in the country. So I think now the government is trying to revoke that power to BRELA so as to ensure there is no any abuse or any unprecedented closure of business in the country. Yeah, and I think other notable changes before another presenter joins is now has been associated by the policy shift, which was prompted by the swearing in of President Donald Trump, who had suspended or terminated some of grants that were being disbursed to African countries, and this had the impact now of dwindling the efforts in terms of prevention and control of HIV/AIDS. So now the government is trying to ensure the funding that was the funding for preventing and control for HIV/AIDS that was previously coming from US in terms of USAID now will be coming will be financed by our own money. And to achieve that, they have proposed a number of changes. For instance, they have proposed to introduce excise duty levy of 20 shillings in beers and wine, essentially to cover for that. They have also proposed to add a levy of 10 shillings per every liter of fuel. They have proposed to introduce a levy for 0.1% on market value of minerals. They have also proposed to revise upwards gaming tax from current 10 to 15% for sport betting activities, and from the current 12% to 15% for land-based casino. And also they have proposed an increase or introduction of a levy that will be applicable on imported vehicles, ranging from TZD 50,000 to TZD 250, which will now depend on the engine size of the car that is being imported. So essentially, all these proposed measures are earmarked to garner, to collect funds that will now be directed to prevention and the control of HIV/AIDS. And the modality is for 70% of the collected revenue to be directed to AIDS Trust Fund and 30% to go to the Universal Health Fund. I think that is essentially all I wanted to cover in terms of a proposed tax amendment for indirect taxes, tax administration, and the regulatory aspect. Thank you.
Thank you very much, Benedict, for that well summarized and presented proposed tax changes. Our dear participants, we'll be having a question and answer session at the end of this webinar. But right now, I'm encouraging you to make use of the chat to post your questions, reactions, comments regarding what has already been presented. And without any further ado, I would like to welcome my colleague Sabato Mwaliki, who is a senior manager at KPMG. He's going to take us through the proposed changes in direct taxes. Sabato, you're welcome.
Thank you, Cecilia. Good morning, everyone. My name is Sabato. I am a senior tax manager at KPMG, and I will discuss the direct tax changes. And from the budget speech of yesterday, it looks the direct tax is only income tax. So I will only be covering income tax because that is what is covered as direct taxes in the budget speech. There are no changes on other direct taxes like payroll taxes. There are no changes. There are also no changes in terms of other administrative issues apart from what Ben has already projected. So I will get started. The very first proposal that the minister announced yesterday was on the small players in the transportation business, in the transportation industry. The small players includes the Bajaji, the Boda, and the minister announced a reduction in what they are paying to the revenue authority, to the government, essentially. Currently, those small players are paying 250K, I mean, 250,000 Tanzania shillings in a year. And so the reduction has happened in the sense that they have been now categorized. Initially, for the Bajaji and the motor vehicles, they were all paying the same. But now the change that has happened is all vehicles that carry up to 5 passengers will be taxed up to a reduced rate of 120,000 instead of the 250. But the remaining between 6 passengers and 15 passengers, which some of the Daladala will fall in, will remain to paying 250. The other change, now this is a bigger one, a taxation of the thin capitalization rules. In this case, the government is redefining what is equity for the purpose of thin capitalization. You remember in 2022, the definition of equity changed to exclude other elements of what you would normally call equity, including retained earnings and share premium. That were removed, and the definition was strictly limited to paid up share capital. And the change that has happened now is to introduce retained earnings back to the definition. So now equity for the purpose of calculations of thin cap will be paid up share capital plus retained earnings. That is kind of a good news coming from that end, because then the risk that most of the businesses were handling in terms of disallowing the interest cost, the finance cost that they incur on borrowings, especially from related parties, that is somehow reduced. But maybe those lost negative retained earnings, that is probably going to make your equity negative, which then means the maximum you can borrow for thin cap purposes is zero. So essentially all the interest being disallowed. So for the profit-making entities, could be good news, but for the loss-making entities, this may be a shock. And again, it's not clear why other elements of equity, such as share premium, is still excluded from the definition, because share premium it can actually be seen as part of share capital. It's only that is paid above the nominal figure. It's the excess of the nominal value, but it's still a paid up share capital, and it's not clear why it's removed if really this is an anti-avoidance provision. The other change is when I saw this, I kind of shocked, because the government is now proposing to tax what you retain after paying taxes at the rate of 10%. Remember now, what is happening is after you have paid the taxes, then the profit after tax is now left to the discretion of the directors of the company to decide whether they see a going concern or make a decision to declare and pay dividend from those retained earnings. But it seems from the government side, that discretion is actually taken out, because some sort of companies forced to make a distribution of all the dividends, of all the retained earnings, because whatever remains in the balance sheet for 6 months is actually whatever remains in your retained earnings for 6 months is taxed at the rate of 10%, and that is the proposal. And could this be arising because of the noises that were happening about CFC rules? Remember, the last 2 years, there have been ongoing disputes between TRA and a number of taxpayers about CFC rules, where the TRA was deeming any undistributed income as distributed and demanding withholding tax at the rate of 10%, as if those were dividends. Now, the issue was the interpretation of Section 75, and there are even court rulings and some other cases still ongoing in the dispute resolution bodies to discuss, to try to find the correct definition or interpretation of that provision. Now, with the introduction of this 10% withholding tax on retained earnings, there are two questions that I ask myself. One is the government admitting that the interpretation they were taking on CFC rules was incorrect? Because if that interpretation was correct, then this is a redundant provision, because they were taxed under CFC anyways. And if this is passed to be the law, then maybe it is telling me the interpretation they were taking, this is an indirect admission that the initial interpretation was wrong. But in any case, this doesn't bring any relief to the businesses, especially the financial services sector or the banking sector, where they must retain some level of capital as a statutory requirement, and the small and medium enterprises or the startups which rely heavily on reinvesting their capital, their retained earnings. So surely this is kind of a shocking news, but yeah, let's see if this proceeds to the bill and finally to the act. But before then, I think we need to lobby for this change. The other change is an introduction of 3.5 income tax on forest products. That is intended to formalize the industry and some sort of an equity principle, because other players are also paying. There's also introduced a 2% withholding tax on payments that arise from purchase of salt from primary mining license holders. Another change is the 10% withholding tax on commission payments that you derive from sports betting advertisements. There are so many of these advertisements, and since the government now is looking for their fair share, and they are starting with a 10%, and this will be a final tax. Another change is that insurance premiums that are paid to non-resident insurers, those normally suffer a 5% withholding tax. But now the government says this provision has been there for so many years, over 13 years, and it has not been changed. So they think it's the right time to change it, to increase it to 10%. What does that has to do with what is the impact to the insurance business? Maybe it will discourage reinsuring with foreign insurers, because those reinsurers may want to pass the cost to the market, which makes the insurance business expensive. Or maybe it will boost the domestic insurance business if people opt for more of the local insurers than the non-resident insurance. But yeah, that is the introduction. Another introduction that is proposed is the withholding tax on professional services and management services provided to the extractive sector, to the mining sector, the petroleum sector, and the oil and gas. The current rate is 5% for domestic services, for all domestic services. Now the change that has to happen here is to move that 5% to 10%. And the reference to 5% means this is targeting a domestic service providers, because for the non-residents, the rate has always been 15%. Alex has mentioned this when he was doing the opening remarks about the alternative minimum tax increasing from 0.5% to 1%. And remember, this change happened a few years ago when it was increased from 0.3 to 0.5 for the loss-making entities. And I think the government has seen that is a good way of making money. So they increasing this to 1%. And alternative minimum tax has been declared illegal in the region, Kenya, Uganda. The funny story is, for us, it's increasing, and now it's going to 0.5%, and that is on top of the 60-40% restriction rule on the utilization of the tax losses, which we are having currently in the law. The other change now is about that restriction that I've spoken about, the 60%, 40% restriction rules on losses has now hit the mining sector, the extractive sector. Remember, in 2016, the restriction rule actually started with the extractive sector in 2016, before everybody else was brought in 2020. And by then, the ratios were 70-30. So the extractive sector is kind of used to this because they have seen this a lot since 2016. But then in 2024, we moved all other sectors from 70-30 restriction to 60-40. But the mining sector, the extractive sector was left out. This year, the change seems to harmonize the treatment across. So that is the change that is being proposed. The last slide from me this morning is the abolishment of income tax exemptions for the EPZ and for the export processing zone and special economic zone investors who supply locally. So this exemption has been there in a number of years, and has been discussed. You will see that that exemption is actually arriving from the actual laws that establish the EPZ and CEZ, and those exemptions has been abolished in those respective provisions. So it's only equitable, reasonable that it is also removed in the income tax. So this is kind of balancing the equation. It is initially those investors were enjoying a tax holiday for 10 years, but that is being abolished. And that is the last slide from me. I would like to take this back to Fiona, maybe, or the moderator. Thank you.
Thank you so much, Sabato. This was very insightful for taking us through direct tax. I'd also like to thank Benedict for taking us through the indirect tax changes. There's so many proposals that have been kept forward in this budget 2025 and 2026. And in our panelists, we are honored to have 4 members that would bring us insight from the industry. Starting with, I would like to introduce Dr. Mercure Ngido, who is the country manager of Barrick and Twiga Corporation. Dr. Mercure Ngido comes with 23 years of working experience. Prior to joining Barrick, he was the associate director of Deloitte. He holds a PhD in commercial science, an MBA in modern commerce, as well as a bachelor degree in finance. Welcome, Dr. Mercure.
Hello, good morning, everyone. I hope you can hear me. Fiona, thank you for the introduction. I think you have covered it all. Thanks.
Yes, thank you so much. Thank you so much for joining us today. So I understand that the mining sector contributes to 10% of our economy in the GDP, looking from the report that was read by the Ministry of Finance. From your perspective, what measures should be taken to increase the investors' confidence in investing more in the mining sector?
All right. No, Fiona, thanks. I think you are right in terms of the sector contribution to the GDP, but also the prospects that the sector will add more contribution to our GDP. But also recently, as we all know, we've seen a number of licenses which have been issued to big mining companies. And we understand that most of these mining companies are finalizing their funding, and some are in the definitive feasibility studies, which if these projects progress, then we'll definitely see the bigger impact to the economy. So I think for investors, one of the things that, give confidence is stability in the policies, both fiscal and non-fiscal, because, mining is capital intensive, it's a long-term investment. And, the projects themselves, to develop a mining project would take at least 3 years. So when you have a stable economy, you give more confidence to the investors. And, if you change the policies, say, for example, when you have the pre-feasibility, and even before you give the final feasibility, before you do the funding, and anything changes in between, that derail the whole, like implementation of the project. So I think that's one aspect. We've seen generally the national policy on for example, for sector, the Mining Act has been quite stable. No other like significant changes. I think there are few purely administrative. But of course, now from the Income Tax Act, you have seen some changes that might also affect the project costs, especially in things like VAT, in things like local content. If we don't support low costs, like local content that suppliers or service provider, those kind of things also affecting the project. So I think for me, that would be the major area where we have to look in terms of stability. I was quite impressed to see in this year, I think there was at least an attempt to cap the inflationary adjustment for 3 years. I wish for most of these fiscal policies also could be capped for a number of years to give that predictability, to the investors. So the other things that can also give confidence to the investor is the supporting industry. So we need policies that would promote local industries, because when we have these big projects, you need support industries. But you can see most of the measures in the recent budget proposal, they're purely to encourage like in-country manufacturing. But I guess now the whole ecosystem needs to be looked at. While you can support on fiscal measures to encourage the in-country manufacturing, we also need an ecosystem in terms of technology, in terms of skills, in terms of business acumen, so that they can transact with these investors who come in the country with the international standards. They have compliance standard they have to meet with the stock markets where they are listed. So all these things needs to be looked at in broader picture. So I'll start with those two items, I think, which can increase the confidence of investors.
Thank you, Dr. Merikiore. It's very insightful. Picking up from your conversation, I understand that you have said that at least over the last 3 years, our policy has been stable, and this is one of the factors that encourages more investors in the country. But you're also looking at encouraging the local miners, as well as being consistent, that this will promote the economy. So overall, do you think that the current budget for 2025-2026 meets your expectation?
Well, I think the way I look at it, it's a consumer driven. That's what I've seen. I think most of the area that have been touched in the budget, they touch the ordinary citizen. I think there is more to be done in manufacturing, especially for industrial manufacturing. So we've seen the encouragement on like promoting consumer product manufacturing in country. But as I mentioned, I think we also need to not to look when you want to do manufacturing, you need the support industries. So you need more on the capital investment in the country. You need policies that will bring in technologies. You need policies that would encourage the core of the industry. So the equipment manufacturing should happen here, So I think it's a good start in the budget. It looks the bigger population in terms of easing the life of the citizen, encouraging local manufacturing, maybe in the food processing and such kind of things, which has a bigger impact in terms of the employment generation. But I think that aspect of encouraging big investments in the support industries, I think also should be looked at, because you need the support industry to support even the consumer industries, but also you need the support industry to support either manufacturing or extractive industries. Yeah.
Thank you so much, Doctor. I think there's a good perspective in terms of the policies being proposed to encourage the mining sector. So thank you so much for your insight and for your time. The questions that are coming in, that will give you an opportunity to address them later on. So for now, I would like to introduce our other panelist, who is Glory Somboy. Glory Somboy has over a decade of experience, and she is currently a tax manager at Oryx. Beginning her career, she started at EY, and she advanced her position to senior tax manager. So she's very prominent in the tax space. Glory, welcome. It's good to have you here. Karibu.
Thank you so much. Yes, I can. Can you hear me?
Yes,
Thank you so much.
So let us start. How do you see that the proposed fiscal measures for 2025-2026 would impact the investment decision in the oil sector?
Okay, thank you so much for this question. From my perspective, I find the budget has reflected a continued intention to support and strengthen the energy infrastructure and also improve the investment environment. However, there are some sector which have, the fuel business, which have been left out, but I believe there will be some room to consider amending some legislation so that it can support the investor investing in the fuel business, that is oil. But in general, the proposed changes have impacted both consumer and investor. And talking about the consumer, there is this road toll that has been introduced on the fuel. Also, this price or this additional cost will be included in the fuel price. But as you understand that the fuel business is heavily regulated, and the regulator is the one who's published the prices upon agreeing with the players. So I think this additional toll will impact the final consumer and not the investor, because the investor is being compensated for all the taxes, because the price build-up almost comprise 40% of taxes, and that has been, is being compensated to the investor. So in this case, the budget has not impacted the margin that the investor gets from the investment in the fuel. But looking on the other side, that we have the reduction of the city service levy rate. So this will provide a relief to other players in gas and lubricant. As I mentioned earlier, that the city service levy, all levies regarding, with respect to fuel, the investor is being compensated in the price build-up that is being published by the regulator. And I also recall on the opening remarks that the speaker mentioned about AMT and the taxation of the retained earnings. So these two issues would impact the fuel business or any business that is loss-making. And also looking at the AMT on the fuel business, this business has low margin compared to other sectors, because the price that is being published, the margins are very low, but the AMT is being imposed on the gross revenue, so which has 40% of taxes. So with this, we think that there should be some discussions around it, prior implementation, because the rate of increasing it to the rate that has increased to 1%, I think it should have some exceptions to the regulated industry like the fuel business. And on the issue of taxing the retained earnings, this in particular, it impacts all investors and not only limited to the oil business or the gas and lubricant. because considering that now the investor is in a dilemma either to reinvest or to repatriate, or in other cases, maybe if it's a local company, then it has retained earnings, then they will be forced to pay tax in advance. But I still think that it also have an impact on the financing cost, because if the dividends wouldn't be retained, then it means that the company will be forced to extend, to go for debt. Of course, it's a good news for financial sector, but on the cost, on the investor, the financing costs gets high. And also looking at on the other side, it also have an impact on the foreign direct investment in the country. So with this, I'm of the view that there should be some discussions around it, so that we can support the oil marketing companies, especially those which are making losses, to support them in business. And to also add on it, the business environment has supported the infrastructure on the natural gas, where there's some exemptions which have been offered to support the investors there. I think with that initiative of the government exempting VAT on natural gas, it will promote growth in that sector. Thank you.
Thank you so much, Glory. You have had an insightful overview in terms of how the increase of AMT would impact the oil and gas sector, the retained earnings, the changes in the retained earnings, as well as the decrease in the city service levy. So I understand for any budget to be effective, the sweet spot from it, there should be a balance between the revenue generation as well as the supporting the overall sector. From your perspective and the ongoing volatility, do you think this year's budget for 2025-2026 actually supports the oil sector?
Okay, from my perspective, on the oil sector, as I mentioned earlier, the AMT is something that needs to be revisited, because it impacts, because these oil marketing companies already have a volatility in the prices. Of course, the global prices keep on going down, but as you understand, this industry is being regulated, and the prices have been regulated by the regulator. So having the AMT in place based on the top line, I think it somehow impacts the sector. But looking again on the other side of where the government has provided the VAT exemption on the natural gas and other equipment for on CNG, that one, I think it will have a multiplier effect depending on the turnaround, the rate of investors getting into investing in CNG on those CNG stations, because it's quite something that is new and it's growing, and it's the clean energy, it's the future now. So I think with the current amendments or the proposals, I believe there should be a room to reconsider the regulated industry who have a regulated margin, so that it can bring some sort of fairness in taxation. Thank you.
So thank you so much, Glory, for sharing insight from the oil and gas sector. And also like to thank again Mary Curie. You two have provided us an insight how this budget generally impacts the extractive industry. So now I would like to move to our next panelist, who is Derek Lugemela. Derek has over a decade of experience in the financial industry. He is currently the Chief Finance and Value. His career in Tanzania Agriculture Development Bank. He later on joined the Bank of Africa, Tanzania, and currently he is the CFV, or the Chief Finance Value Officer at Stanbic Bank. Welcome, Derek. We are honored to have you here with us today.
Thank you. Thank you, Fiona, for the introduction. Thank you so much. Not sure if you can hear me.
Yes, we can hear you.
Thank you.
So Derek, when I was going through your CV as we were preparing this year's budget, I couldn't help but notice how much experience you have in the finance sector. So my question to you would be, this year's budget, the 2025-2026 plan, do you think that it covers the vision that we had when we launched the 25 years vision plan for Tanzania in terms of the financial inclusion, the capital market deepening, and how the tax policies can be used to effectively accelerate this agenda?
Thank you, Fiona. So I think if you go back, back to 2009 and look into the number, almost half of our population was actually financially excluded, and that number was actually 55%. And we're looking to the data today, that has actually dropped from 55% to 18.7%. So there have been, significant improvement, and this is not really, just the statistical data. I think for me, I think it's a very positive story of empowerment, access, and opportunities as well. When looking to the Finscope report, which was now, comparing the situation from 2017 to 2023, we saw access to the financial services increasing, from 86% to 89%, and the usage for those services actually improved from 65 to 76. Much of that was actually had to do with the mobile money usage, which increased from 60% to 72%. And this is, as much to do with a lot of innovation, which we have seen on the telco banking services, but also fintech, but also I think more of a partnership between, these three players as well. When you look at it from the banking industry, again, we have seen, I would say perhaps a modest improvement where we improved from 17% to 22%. I think you'd say, like I've mentioned, so it's modest, but again, this has to do with when looking through the structure of how Tanzanians do receive income. I think you know that almost more than 40% of Tanzanians do receive their income occasionally. And of course, you have almost 44% of Tanzanians who receive their income from, agricultural produce. And of course, less than 10% of those who are receiving their income formally from the normal salaries as well. So I think there is a room to move more of those to a formal sector. And when looking to, I think, the Vision 2050, which is the new vision now, you can see the government committing to human development, but also, committing to job creation, but much more committed is more ensuring that actually more than 50% of the jobs which are being created, they're the formal jobs as well. So I think that is also going to help of seeing more of Tanzanians actually also moving to the banking sector. So, what is driving this progress? I think there are key three reasons there. One is technology, another one is policies, as you have mentioned, and I think the bigger one is actually partnership, where we have seen, we have seen an increasing adoption of the digital platforms, but also we have seen the government and the private sector coming together to form what we call the National Council for Financial Inclusion, which, in a way, put forward some of the specific policies which, all the players within the industry have been actually working on for the past 10 years now. And again, I think more important, what we have seen as well is also the government, where today, for instance, if you're making any payment to the government, perhaps you'll have to do that digital. We have seen the GPG, we have seen Luku, Water, TLA payments, and I think all those improvements really has supported the digital and financial inclusion which we have been driving from the financial sector. That doesn't mean there are no pockets of opportunities. I think when you look into the data, and I think you spoke about that when you were presenting, when looking to the payment system, for instance, at the moment, and as per the Finscope, we noted that almost 98% payment for groceries currently is still being done on cash basis. And I think, and we're looking to the same data as well, almost 70% of Tanzanians, they're still borrowing from family and friends. So I think there is a room there. And that speaks of some of the initiatives which we have seen through this budget. We are seeing the government reducing VAT from 18% to 16% if you're making those payments online. We are seeing the government reducing the transactional charges, which are being charged by telco and banks as well. We have seen initiatives being driven by the central bank where, the introduction of tips, which has made it much more seamless for banks and telecos to connect seamless and be able to service the customers. But again, we have seen, of course, also intentional financial literacy programs, which are being driven by banks, but also the government as well. So I believe all those, if we continue working on them and some of the policies which we have had today, we will continue seeing much more adoption, especially from a payment angle. Speaking of the capital market, as you have touched on, I think again we have seen we have made commendable strides. I think some of it is the introduction of the new products. We saw the introduction of Skook, which caters the museum community. We have seen the introduction of sub-national bonds. We have seen some of the water bodies in Tanzania issuing the corporate bonds. We have seen some of the state-owned entities at the moment also going to the market and issuing some of the bonds as well. We have seen fund management products being reintroduced and being restructured. And I think we have seen also the digital adoption on the DSE, partnering with banks and partnering with telecos as well, so that to make it much more easier for most of the Tanzanians to participate on the capital market. And I think perhaps the significant improvement or changes which we have seen is the participation of the retail customers on the government bonds. If you look into the data, for instance, Fiona, on the when looking into the government bonds holding up to April 2025, which was around 34 trillion, actually 60 trillion is owned by the retail and other category and individuals as well. And I think that has increased by almost 2 trillion from 4 trillion April 2024 to almost 6 trillion April 2025, and it's almost 17% of the total holding of the government bond. So I think we have seen more individuals. Perhaps if you speak to the bigger communities on this call, they own part of the government bond, and I think that is also somewhat encouraged from what we have been seeing. And again, I think lastly, what we have seen there is also, I think banks taking opportunities because of all these developments. The banks like Stanbic, which is one of the leading investment bank in Tanzania, we have seen, participating and being at the forefront in terms of some of structuring these transactions. We had, for instance, the NMB First program, which was issued a couple of years back. We have had CRDB Green Bond. We have had the recent Mama Samia Infrastructure Bond. All those were actually Stanbic were a lead advisor in terms of those transactions. And I've seen, I think, other banks as well, playing a key role on those specific areas. But again, our capital markets still have some few challenges. One, liquidity. Secondly, it's also the narrow investor base. You'd imagine almost less than a million Tanzanians currently registered on the DSE platform, but also the sectoral concentration in terms of listing. We still have some of the key sectors like building and construction, which is growing at a very high pace, mining, which we spoke of and has been also growing at a very high pace, the financial services as well, which are not really registered on the capital market. And I think I'd love to see more of those also participating. So I think maybe let me start there, Fiona, before the follow-up question. And sorry, I can't think I'm struggling to put on my video, but over to you. Thank you.
Thank you so much, Derek. This was such an insightful presentation from the finance sector. Now, just picking up from what you've told us, you went through that technology, policies, and partnership are one of the areas that if we concentrate on, the finance sector can move forward, as well as the challenges that the financial sector is currently facing is from a perspective of liquidity, the narrow tax base, as well as the sector concentration. So I would just like to have your view. What are the opportunities that you think the financial institution, not only the banks, as well as the institution handling the microcredits, can leverage on, in particular from the tax incentive, so as to promote financial inclusion?
Thank you. Thank you, Fiona. I think there are, like I mentioned, there are still pockets of opportunities. I think one, like I've mentioned, so we saw the government introducing waiver or withholding tax waiver on corporate bonds. I think if we can do that on the commercial paper, that could also help. But also in terms of the capital market today, for the retail investors on the DSC, when they're getting paid the dividend, there is withholding tax on that. I think perhaps you can have a waiver, you can attract much more Tanzanians participating on the capital market. I think the other one around financial inclusion is they allow opportunities of reducing some taxes on the fintech infrastructure, so that then we push much more financial inclusion. The other area which I think is critical is around, SME space. When looking to the banking numbers, for instance, Q1 financials, some of the banks which are actually focusing on the SME, posted notable growth. You have banks like, let's say, Mwanga Kika, for instance, which grew their balance sheet year-on-year more than 50%. When you look at Stanbic, for instance, our enterprise banking section grew by more than 70% year-on-year. So banks have appetite, to go to this sector and to drive the economy. But I think we could have much more, tax incentives, and I think a couple of them is really around increasing or the tax thresholds. We have seen some initiatives around border and motorcycle, but I think we could do more on some of the other sectors. But also simplifying compliance. I think most of these SMEs, you operate for 3 years, and then the tax bills comes in and this is quite significant, and you see much of those, in a way going under. So I think there are opportunities around those specific area, but also in the banking sector, and some of them were also touched on. We still have some few challenges on the thin capitalization. We had proposed banking sector to be excluded because the business we do is much more basing on the capital base which you have built. So you can't grow if you're not growing your capital base. When you look at the changes which have been introduced, 10% of retained earnings, and perhaps again the changes on the thin capitalization, I think there could be more. We had requested perhaps the banks could be excluded on these provisions, or if not, then if possible, then deposits for banks could be excluded from the definition of debt, so that banks could continue growing. So I see opportunities around that specific area. There have been some few issues which have been outstanding for quite some time. One being the treatment of loan written off. I think we're still having a conversation with TLA and the government. They had promised to issue the regulation, so we'll also continue engaging on that specific area. And another one I think is around the treatment of interest in suspense. But I think those are some of the areas where I see opportunities. And maybe lastly, Fiona, I think what we have seen as well, it has been the appetite of banks to support some of the key sectors. So when you look into agriculture, for instance, lending to that sector has been growing to the north of 50% year-on-year, maybe for the past 2-3 years now. And we're looking to the Q1 numbers, that sector, the lending to that sector grew by almost 30%. So I think more incentives on those sectors which are driving the economy is very critical. But there are some other sectors as well. You talk about transport and communication. We have seen the government investing quite heavily on the SGR, but I think the biggest question is how do we commercialize that? How do we bring in the private sector, for instance, on the cargo space, and banks like Stanbic, and I believe others as well, have interest to invest more on those. So I believe some policies on some of those sectoral sectors, I think could really help. And maybe last is actually around hotels and restaurants. This is a sector which is very critical. I think Alex spoke of the tourist arrivals in the country, but I think when you look into the lending to this sector, has not been really growing. Maybe for the past 3 years, it has been below 5%, but it is picking up now. It's actually at around 70%. So what more could we do to support those sectors so that the banking sector could come in and support the SMEs and other corporate and other players in those sectors? I think that is also very, very critical. Thank you, Fiona. I'll end there.
So thank you so much, Derek. I really support you from your perspective that promoting other sectors, the transportation sector, the SME, that would, when they grow, that the financial sector would be also able to grow. So that's a very good way to put it and look at it. So I would like to move into our next panelist, who is Dr. Murray. Dr. Murray has over 25 years of experience and he is currently the Executive Director at REPOA. Dr. Murray holds a PhD from Erasmus University in Rotterdam and an MBA for Egano. He also has an master's and a bachelor degree in economics from the University of Dar es Salaam. He is specialized in policies, research, and development. So today he will be bringing us insight from the economic perspective of 2024-2025. But before we deep dive into the presentation, I would like to ask Dr. Murray that we've seen that the budget has increased by 13.4%. That is from 50 trillion to 57 trillion. With the current budget for 2025 and 2026, how do you think this is sustainable, considering the upcoming general election, the debt financing, and the government wage bill? How practical is this from your perspective?
Good morning, everyone. I believe you can hear me.
Yes, we can.
I had some technical hitches in the morning, but I think now this has been resolved. Yes, I have noted, of course, the what I would call rigidity in the budget that keeps increasing. And when I heard the minister's presentation yesterday, he said that the budget execution was actually at 86%. That was what was realized and approved spending vis-a-vis the budget. So it has been a trend, but it's probably quite challenging. And as you will see in one of my presentations, you see that the spending has been rising faster than the domestic revenue, which means it is likely to increase the demand for external financing, particularly in terms of borrowing, because you will note that also in one of my presentation, I show that there's been a declining trend in official development assistance and grants for the past 7-8 years to Tanzania. So that means to sustain this this kind of budgetary increases, it's obvious that external financing source, unless significant resources are mobilized from the private sector, domestic private sector, to finance some of the public projects. Otherwise, I see and of course, as the minister showed, that the debt to GDP has increased to about 40%, while it's still manageable. It's below the threshold, but it is indeed rising, and it's likely to continue rising.
Thank you, Dr. Murray, for your insight. So I would like to take this opportunity to welcome you to proceed with your presentation of the economic overview. Karibu.
Thank you, Fiona. I have my slides sent, and could you please have the slides shared on the screen? Yes. Next slide. I think what I was trying to do here is to place the current budget on a trend that has been happening. You can clearly see that the growth rate of Tanzania before COVID was on an average of 6%. But COVID period 2020, definitely you see a quite dramatic decline. And then it has started to peak again, but it's still much below the pre-COVID real GDP growth levels. You can see that the economy of Tanzania has been relatively resilient, but of course, it's still vulnerable to external shocks, as you could see during the COVID pandemic and the related crises. The minister indicated, of course, that was a revision. Projection was to reach 5.6%, but we were able to achieve by 2024 a growth rate of 5.5. Still a relatively good growth, but definitely below what we would expect to grow to be able to achieve meaningful poverty reduction. But the projection for next year, as the minister indicated, is to reach a 6% growth rate. Next slide, please. If you look at the inflation, it has definitely declined, despite the spikes that were observed after the post-COVID recovery, and of course with the European geopolitical conflicts in Ukraine. Prices went up sharply due to imported inflation, primarily from energy and food costs. But the government has implemented quite a number of monetary and fiscal measures that helped to curb the inflation. Of course, with a good harvest of food crops, that also helped to reduce the inflation. Now, as you could hear, the minister yesterday said public debt is still, we can still sustain it at the moment. You could see the trend of rising public debt as a share of GDP from 34% in 2017-2018 to about 36.4. This was the year, financial year 2023-2024. The minister indicated yesterday that it has increased to 40%, still below the threshold. But now the major challenge that I see, the risk that I see, there are a lot of, we still have a lot of demand for public investment needs to be able to expand productive capacity of the economy and human capital development in health and education, and as the population is rising, and the minister indicated that yesterday. The major challenge that I see is the share of domestic revenue that goes to servicing debt. It was around 26.3% in 2017-2018. It had risen to 44% 2023-2024. So the most important thing here will be perhaps to increase the denominator, that is the domestic revenue. I've seen the minister's presentation yesterday indicated that it's likely that the tax to GDP will increase to 13%. I would like you to note that this is still below sub-Saharan African average, of course, because of a large informal sector and other factors. Definitely, that is something that we are of concern. The major risk here is, of course, the possibility of exchange rate fluctuations, particularly where we have dollar-denominated debts, efforts to raise domestic revenue mobilization, as I indicated, but also to look at the expenditure rigidity. We have rising expenditure, both the development and the recurrent. So rising expenditure without corresponding increase in domestic resource mobilization will definitely mean that the ratio of debt service to domestic revenue will increase. Next slide, please. Can I move the slides myself? Or? I also looked at, as I indicated earlier, the share of official development assistance. As you can see, the graph there shows the top one the trend shows that the official development assistance globally, both DAC and non-DAC countries, has been growing, but not for developing countries, neither for Tanzania. I think this official development assistance is growing to countries other than those in developing countries, and Tanzania as well. So that's why I say options for financing the budget will have to remain domestic revenue, but most likely, if domestic revenues cannot expand, it will have to be reliance on debt financing. Next slide, please. As I said, the grants that are received from the official sources, as you can note, it has been declining since 2012, 2013. It's not a phenomenon that started recently. There have been some fluctuations, but overall, compared to the climax of 2010, 2011, actually the trends has been quite a dramatic decline in the grant receipts. Next slide, please. Now, here I'm trying to show the trend, the implication of this financing mix on the budget, domestic revenue, resource mobilization, and public debt. What you can see, both development and recurrent expenditure has been growing. Of course, in the current budget compared to the prior year, the current budget has risen faster than the development budget. But all what is showing, the light blue trend there shows, yes, rising in domestic revenue, but total spending is rising faster than the domestic revenue, which means there has to be external sources of financing. So no wonder that the debt to the GDP ratio is growing. Next slide, please. I was trying to look at the growth scenario, what sectors are driving growth. As the Minister for Planning had indicated in the morning, you will see that arts and entertainment, production and distribution of electricity, communication, finance and insurance, and health. These has contributed much higher to growth compared to productive sectors, particularly agriculture, which, as the minister himself had indicated, yes, the growth has increased from 2% in 2021 to 4%, but for a much rapid poverty reduction, the linkage between growth and poverty would require significant growth in these productive sectors, particularly agriculture. The budget, as indicated by both ministers, will focus on promoting competitive and inclusive economic growth, to strengthen production of industrial goods. And you noted, of course, quite a number of fiscal measures were introduced to promote industrial development. The colleagues who discussed the tax measures has alluded to those. To accelerate investments and business growth. Now, I'm not sure in terms of the business environment how much the newly introduced tax measures. I've seen some reduction in some fees and levies that directly affect the business environment. At the same time, I've seen the introduction of withholding tax on retained earnings. I think that's something that the government might have to reconsider, because retained earnings are means of accumulating internally generated capital for reinvestment and growth. But also to accelerate human development and in terms of education and health, and also specifically on the human capital development. The target for real GDP growth, as I earlier indicated, is 6%. I think it's easy to achieve that from the current 5.5%. The most important thing is this growth has to be driven by the private sector. It should not be as it has been over the last few years, where growth has been primarily driven by public sector investments. Next slide. I think you have gone too far. Yes. Now I'm trying to think about what these budgetary implications further on sustaining economic growth, but also structural transformation. I think to achieve the goals that we have set ourselves in terms of higher middle income economy, but also to accelerate poverty reduction, we will need a much higher growth rate, I think into the double digits. But that would require efforts to raise factor productivity, particularly in agriculture, but also manufacturing. We've seen that these sectors did not contribute to the 5.5% growth as they have been these other sectors that I have highlighted. That will require a lot of efforts to ensure policy coherence, but importantly, private sector growth. So we have to think about these tax measures, to what extent they are going to affect domestic savings, but also attracting foreign direct investments. Because these are critical. We still have significant infrastructure gap, much as we have seen a lot of investments in railway, airports, ports, but a lot of work need to be done. Now, this entails that in addition to setting the right priorities, we might require also to reconsider our financing options, particularly to bring in the private sector in terms of PPP, joint ventures, and other financing modalities. We talk about the inclusive growth, but when you look at our GDP components, the traditional expenditure methodology, look at the government expenditure, which is comprised of government spending, investments, household consumptions, and a trade gap. X means exports and M is imports. When you look at our data, you see that domestic absorption is actually higher than GDP. If you rearrange this mathematically, you will clearly see that we have increasingly higher trade gap. That means there's a reliance on foreign inflows. The challenge is these foreign inflows increase vulnerability to change in any global market conditions. And we could clearly see what happened during the COVID period and during the period where we had to sustain higher input energy imports and so forth. We need to grow exports significantly to be able to close this trade gap, but that will require efforts to strengthen competitiveness, to attract FDIs, although we know that these are not necessarily inequality reducing, but nevertheless, we need to accelerate growth. We need to be competitive. So the business environment is quite critical, and the tax measures has to ensure that it does improve the business environment. I've talked about a lot about the rising external debt. I don't want to go back there. But what we see is, of course, there is some risk to long-term growth and inclusion, which would definitely require strong economic and export diversification, strong investments in education and skills and technology so that we can raise productivity and ensure that private sector grows to create jobs. But in areas where the poor needs to be protected, of course, we have to think about expanding the social safety nets for the poor and vulnerable. Next. I talked about income poverty reductions. Any budget efforts definitely needs to see that the growth that we are reporting, the minister is talking about 6% next year. It has to ensure that poverty is reduced. But what we have seen over the last 10 years or so, yes, we have had sustained high growth rates, but poverty reduction has reduced only marginally by 8 percentage points over the 10-year period. That means the elasticity of poverty is actually quite low. For Tanzania, is minus 0.3%. Is much lower compared to -1 average of sub-Saharan Africa. We have the problem that we need to consider, and I think when discussing the budget, we have to see how issues of population growth and the demographic structure are taken into account, in particular in relation to productivity, output, but also in terms of allocation of public spending, in particularly the social sectors of education and health. We need to allocate much more because the population is growing. But that population, if a large share of it is dependent and not really engaged in productive activities, that may signal some challenges that the future budgets need to take into account. Next slide, please, the final slide. Now, my final slide actually, it was supposed to be in bullet form, but I'll try to explain what I'm. What we have seen, of course, the government have tried to respond to the sudden decline in official development assistance, especially from USAID, which was financing the health sector. You have seen the allocation increase of some taxes on alcohol, beer, wines, and spirits, of which 70% will go to finance tactics and 30% to the National Health Insurance Fund. That's a good thing. It is the issue of execution and actually how the budget can be realized. But we've also seen introduction of some taxes to respond to environment, particularly emissions, and so I can call them carbon taxes. These were placed on some petroleum products and also natural gas. We have seen the minister introducing some measures to strengthen domestic resource mobilization with expected tax to GDP ratio of 13%. But we've also seen some measures to support productive sectors, especially agriculture and domestic manufacturing. There were some taxes that were removed on pesticides. There were some taxes that were introduced on imports of some plastics, which they need to encourage a domestic production. And many others that my colleagues who were presented earlier on tax measures have spoken about. But also the measures to improve the business environment. We've seen the introduction of, actually the reduction of some of the local government taxes. So there are some amendments on the Local Government Finance Act, reducing some of the taxes on turnover, like the service levy and so forth. Of course, other measures in the regulatory environment needs to be taken into account if we are to strengthen our business environment. That includes, of course, I've seen that the minister also introduced measures to limit the powers of licensing authority to close accounts or to close businesses. So I think this is a good move. We need to examine in a lot more detail to see what will be the actual financial impact on businesses. So I would like to stop here and thank you for your attention. Back to you, moderator.
Thank you so much, Dr. Mar. Thank you so much, Dr. Mari, for your insight. You have given us a good review on the performance of 2024 to 2025 as as well as what we should look forward in 2025, and where we'll be addressing the various questions that ask on return earnings. Sabato, would you like to take this and expound it further? Maybe for somebody.
Thank you, Fiona. I understand that is a question that is attracting our attention because of the impact that it carries, and surely that impacts all of us. I mean, all the business community members, the business players in every sector, because that is I think the core business element is you generate income, and you would want to use that money to generate income as in the next year. But the government seems to accelerate the distribution. In normal business setup, distribution income should be a return on investment. And in essence, it is the shareholders who pays the tax on dividends, not the company. But the move that we are seeing now is the government moving to tax an amount that the shareholder has not even received. It's still in the business's books. So I think it also some sort of misalign with the principle of withholding on payment or even on accrual, because there's no any accrued income for the shareholder, because there's no any dividend declared, there's no any distribution made or even intended. It's just money sitting in the retained earnings. So I know there's been a number of questions in the chat which we have already addressed. So maybe we encourage the attendees to raise hands, so then we can address specific issues that they may be having. So maybe, Fiona, if you can take questions from the poll. But yes, an issue around retained earnings and taxation is an issue that requires maybe more lobbying before it becomes a law.
Thank you, Sabato, for your insight. As we are waiting for our participants to raise their hands and ask the specific question, there's a question that came in directly to Dr. Murray. It states, I am a layman when it comes to economics. Can Dr. Murray expand on why should growth be driven primarily by the private sector and not the public sector to achieve the target of 6% real GDP growth? Over to you, Dr. Murray.
Yes, I think what I meant here is yes, both public sector investments and private sector investments drives growth. The problem with the public sector driven growth, and particularly investments in infrastructure, these are investments with long gestation period. They do not translate immediately into poverty reduction. But the private sector growth, oftentimes, private sector driven growth is associated with creating jobs, and therefore more immediately increasing household consumption, and therefore having a much stronger linkage between GDP growth and income poverty reduction. That is really what I had meant.
Oh, thank you so much, Doctor. So from your perspective, is that it's more directly to the private sector because it's easier to achieve the growth in comparison if the growth is driven by the public sector. I see that we have a hand risen. Please welcome.
Hello.
Welcome, Amulike. I see that you've raised your hand.
Okay. Thank you very much. I just need a bit of clarity on this issue of withholding tax. First of all, let us be clear on one thing, that this is supposed to be prospective rather than retrospective of our retained earning. That's the one thing I need clarity on that. Then another issue which is not clear to me, the issue of 6 months, if not distributed within 6 months, then you need to pay withholding tax. Then what about after 6 months? I don't see any explanation that. The main point is I want to see the difference between 6 months and after 6 months. Then another thing, withholding tax has been always corporate tax withheld in advance. Now, for this case, retained earnings, something which corporate tax has already been deducted. Now, why calling it as withholding tax? Does this mean once we withhold it, we can claim back to TRA, or is just corporate tax over corporate tax, just in another way around, being called it as withholding tax? But in other perspective, it's corporate tax 30% already paid, then additional corporate tax 10% on top of 30%. I hope I'm clear on that. Thank you.
Thank you, Amulike, for your question. Sabato, would you like to address this question?
Yes, thank you so much for the good question. And as I said, there are many questions that we hope the finance bill will be drafted to address those questions. Because clearly we need to see which specific provision of the law is amended. Is it because for withholding tax, we have 3 types of withholding tax in the law. One is withholding tax on employment remunerations, and definitely this is not. The other one is withholding tax on services, and this is not. The last one is withholding tax on return on investment. So if this is put in a category of withholding tax on returns on investment, then that would mean this cannot be treated as an advance tax, which would otherwise be creditable, but rather it will be treated as a shareholders' tax, which comes after tax. So it would be some sort of a deemed distribution, a deemed dividend declaration. Same as when you declare dividend, you actually withhold the tax on that dividend, and you do not claim that as a deduction. It is meant to be a tax burden to the shareholder who is deriving a return on investment made in the country. So if the perspective here is to treat those retained earnings, undistributed retained earnings, as dividends, then I think the discussion will go back to what I was saying earlier, that this is some sort of discouraging the investment in the country, and for the sectors that depend heavily on this capital or reinvestment of profits, such as the startups and the SMEs, they will be impacted significantly. So I would want to park that until we see the finance bill, because then it will be providing some insights that can be helpful to answer the questions that we have. But the question around whether this can be retrospective or prospective, I think the speech says this is introduced on retained earnings after 6 months. Now, retained earnings is an earning that you have after you have paid the tax, and tax is paid once when you file your final income tax return, where there is a provisional returns in the year, but the return of income is filed 6 months after your year end. So you close the year, say in December or in March, and if you closed in March, then it means by September 30th, you will have to file your return. By then, you'll be having audited financials, and they will be having a retained earnings at the end of your P&L or statement of changes in equity. If that amount is then taken to be the cumulative amount that is taxed, then yes, there could be issues around double taxation, because that number is cumulative. It may also imply that some numbers that you taxed in the previous period is also brought into the tax net in the subsequent period, unless they then tax the movement between this year and the previous year. So I will have to admit that there is a good number of questions on this, and we are all looking forward to clarifications in how the law is then worded. From there, definitely KPMG will do a newsletter that will be circulated to all of us. But otherwise, keep in touch with us, and we'll always be happy to respond to the specific questions around this and any other issues. So issues around double taxation could be true. Issues around how this works, is it advance, is it a creditable tax or a tax on tax, that could be true as well, but we are unable to ascertain at the moment, Amrike.
Thank you, Sabato, for your insight. I believe this would answer a lot of questions that are being posted regarding the 10% withholding tax on retained earnings. So I would like to invite Samuel Esupu. Samuel Esupu is a tax partner at KPMG, and he is also a director in KPMG East Africa. So Samuel, would you give us your insight regarding the 15 days discard for the waiver application? Our participants are posting a question whether taxpayers' receipt issuance would assist the reconciliation of sales. And does it mean that they'll also be having an access to the EMS system? Welcome, Sam.
Thank you, Fiona, and good morning, everyone. Just to put into perspective the two questions that you've just asked, I think the first one in terms of the tax administration changes, we have definitely seen some sort of a not very clear provision that the minister is proposing to include there. Because currently, for you to be able to get a request for waiver or to pay a lesser deposit, you need to make an application within 15 days from the date of your tax decision. Now, if you are to look at the proposed change, it's not very clear in terms of whether the tax decision referred to this point in time is that either you're extending the 15 days to 30 days, or whether you are waiving altogether the requirement of payment of the deposit. You can see from our neighboring countries, Kenya and Uganda specifically, I think one of the things that they've done in their law is that they deem payment of the deposit as unconstitutional. So that was not sort of a requirement that is not going to be there. Are we going to the same direction? I don't think so. The wording is not very clear. Still leaves room for interpretation. But my expectation is that once we have the finance bill, we'll definitely be able to see the proposed wording that is going to be included in the tax administration. Because currently, if you are to read the proposed change in conjunction to Section 51 of the Act, and again, the tax administration regulation, definitely you won't be having a clear answer in terms of what is the expected reform, whether it's 15 days added to another 15 days to be 30 days so that you can apply within the tax decision period, or whether the decision to make a payment will come after the decision to make whether to waive or to make a payment comes after, then you count 15 days from that point in time for you now to be able to make a payment. So that is still not clear. So, but we would expect the finance bill to clarify that. But at the same time, I would expect the clear intention in terms of why was this proposed change proposed, so that the objectives in the finance bill will be very clear in terms of what was the intention from the minister to propose this particular change. In terms of the EMS, I think the conjunction, there's a question around you had asked in terms of the interface between the TRA and the taxpayers. So we do expect a bit of challenges there, given the fact that as we speak currently, the normal ESD machines that we are using also have challenges in terms when it comes to reconciliation. Now, the question we're asking ourselves is that are we now moving to a situation where everything is going to be done electronically, that's through the e-invoicing system, so such that the commissioner will be in a position to be able to track everything in real time. Currently, we're having challenges when it comes to reconciliations, and we have all, as taxpayers who are using the machines, seen scenarios and situations where the amounts that are reported in the system and the amounts that we're having in your system of the taxpayer are quite different. And that sort of gives challenges when it comes to tax audits. And this, in most cases, we have seen resulting in additional tax payables, which might not be necessary in the first place. So probably a right move, but we should be able to see that whether the new system is going to be able to fully resolve the challenges that we are seeing when it comes to reconciliation and data collection. So probably let's wait and see. Still a new space, but we have seen, if you're looking at the other jurisdictions, give a good example, our colleagues in Kenya, they have more or less the same system that we are proposing to introduce. And I think let's probably learn from them in terms of how they've been seeing it moving. But so far, I believe for them, they still have access, which we currently don't have access to the data the TRA are holding. So in case this system is improved, and we should be able to, let's say, for instance, see our reports when it comes to our sales in a month, which the tax authority is holding and what we are holding, then I think the problem of reconciliation is going to be resolved. But again, we should wait and see in terms of how that is going to be implemented. Fiona?
Thank you so much, Samuel, for extensively covering this. So I'd like to remind our participant that you can always raise your hand, then we will give you an opportunity to ask your question. But if you're not comfortable, feel free to leave it at the chat box and we'll address it accordingly. So I see another question that is stated, can I get more clarity on the purchasing online VAT reduction from 18% to 16%? Benedict, would you like to take this?
Thanks, Fiona. So as I said when I was presenting on this amendment, I think the essence here is the government is trying to prompt a shift from a cash-based economy to cashless economy, where the cashless economy will play a big role in addressing the revenue leakage that is prevailing currently in the country, prompted by the cash-based economy. So the essence here is those who will be doing purchases online, specifically for goods, they'll be provided with a preferential VAT treatment that instead of paying 18% on that good, if it was purchased on a cash basis, now they'll be paying a 16%. So there'll be a cost relief of almost 2% when they are making that purchase online. And I believe the finance bill will then come out with more clarity in terms of for those who will be selling, how will they be differentiated? So my expectation is there might be some sort of registration requirement whereby for every trader that will be trading their products online, they might be required to go and register with the TRI. and then once their status is confirmed, then they can then be permitted to trade those goods online at a VAT rate of 16%. But the actual essence is just to try to push toward a cashless economy by offering a preferential VAT treatment to those who will be making a purchase online. Instead of paying 18% on goods, they'll be paying a 16% on those goods. So that means, let's say if one is trying to buy good day, if he goes to Kariako and he pays for that, then that means he'll pay VAT equivalent to 18%. But if the same persons look for alternative to purchase that online, then that means that person will still pay 16% on the same product. So a cost relief of 2%. Thank you, Fiona.
Thank you so much, Benedict. I believe also this was covered during Derek's presentation. Unless if Derek, you'd like to add on to this, what this would mean to the financing sector.
Thank you, Fiona. Am I audible?
Yes, you are.
Oh, thank you. I think much of it has been covered, but I think if you speak to to significant part of the business community in Tanzania, and especially SMEs, like I mentioned earlier, the bigger part where we need to see a bigger part of the adoption in terms of technologies on the SME space. But some of the SMEs, I think they have been some are worried to adopt some of this technology because when TLA comes in, we'll get the statement of all sales, and then based on that, the taxes will be estimated. So I think adoption is key, like I mentioned. So currently, you still have almost 98% payment for the grocery being done on cash basis. We need to move from that, but also at the same time, we need to make compliance for these SMEs in terms of tax payment, much more easy as well, so that then someone doesn't feel somehow penalized by adopting the technology as well. So I think much more policies around that is also very critical as we drive the adoption as well. Thank you.
Thank you so much, Derek, for your perspective. So we have another question directed to Dr. Murray, that you talked on the implication of domestic revenue financing public debt. Could you please expound on that, as in, is it good or bad if the trend increase?
I think I agree. It is, in fact, a good thing that we need to increase more reliance on domestic revenue so that we can reduce the dependence on debt or even foreign development assistance. What needs to be done, of course, is to strengthen our extraction of rents from natural resources, minerals, gas, forestry, and so forth. And this is possible because I've seen some, and of course, to try as much as possible to widen the tax base. Currently, quite a big part of the economy is operating informally, and meaning that there are quite a number of people and businesses who are not in the tax net. So, and this is possible. Some countries in Africa, such as Namibia, even Mozambique, which has a similar economic structure like Tanzania, has a much higher tax to GDP ratio, above 20%. So that's possible. In Tanzania, in terms of tax to GDP ratio, is still below sub-Saharan African average of 16%. So there are a lot of more efforts that are needed, and it's definitely possible to ensure that we widen the tax base, but also to ensure that natural resource rents are actually captured as much as possible, so that we can raise our domestic resource mobilization base. Over to you, moderator. Over to you, moderator.
Dr. Mari, I can hear you. I
Okay.
think maybe the moderators are facing a challenge, but I
Okay.
can hear you. So if there are any questions that can be asked verbally, we are still here. We can handle those as the moderators are trying to come back.
Okay.
So for the audience, feel free to raise your hand, but there are questions in the chat as well, which we are addressing lively.
Probably Sam, you can
Yeah.
pick those questions in the chat
Hello?
and answer them.
Yeah. To respond to some of these questions. One in terms of, I think there's a question that we ask. Please confirm if this will be applied for the return of the retained earnings for 2025 going forward, or including previous retained earnings. So we would expect to have guidance from the finance bill, but reading the speech that the minister read, his proposition is that all the changes are effective from 1st of July going forward. Now, if that now applies, then what it means is that in most cases, we don't expect tax changes to apply retrospectively. Then we'll be expecting those changes to be applying from a period from 1st July 2025 going forward. The provision, I think, as my colleague Sabato had spoken about it, in terms of the CFC rules that we have been challenged to the Court of Appeal as we speak, more or less aligns to this specific change in law. And the question now becomes is that most investors or most businesses use retained earnings to finance their operations and to recapitalize the business. Now, the expectation is that if you are to introduce these changes as of this June and effectively come into force from 1st of July 2025, then we'll definitely expect those to go to start to be effective from that particular point in time. But the only challenge now we foresee is that you're having a December year ends taxpayers, you have a September year ends taxpayers. What does that mean in terms of the period between 1st of July to the end of the financial year? We probably expect to have transitional arrangements, same way we had when the VAT Act was introduced back in 2014. And if we don't have such transition arrangements, then definitely we're going to be having challenges in terms of at what point in time are you going to be imposing that retained earnings tax? Is it from the period from 1st of July, let's say, to December, or is it the full financial year? And how do you allocate that amount between those particular periods? So definitely there might be a challenge. We'll probably expect to see let's expect to see if the minister and the parliament are going to pass a finance act that gives transition arrangements and the impact. We also saw a question around VAT agency, the 3%. To speak to that, I think if you're to look at the finance speech, the Minister of Finance speech, specific on the VAT on the Agency Commission, would expect payments from particular parastatals and the ministries, specifically the Minister of Finance and some parastatals of the government. But the same speech gives guidance that they are going to issue specific regulations in terms of how that modality is going to work. Just probably to give context, our neighbor in Kenya and Uganda, from an East African perspective, do have VAT on agency. And the way it is actually done is that for invoices that are issued to the government, actually before the government pays the supplier, they deduct the part of the VAT element in remit as VAT, as a way of withholding agency. So what that means is that we expect the guidance to come through to clearly state that if you are to issue an invoice and the invoice that has been issued to the specific ministry or to the specific parastatals that are going to be listed, then definitely before they actually pay you, they should be paying, if it's a service fee, they'll deduct the normal 5% withholding tax that will be remitted, but we'll also be expecting they'll be deducting the 3% VAT out of the 18% from your invoice. And they should only be paying you a balance of your 15% from VAT and your 95 if it's a service fee. What that does now is that it's a bit of a challenge in terms of whether when you be in a situation that you're invoicing and they deduct the 3%, but it has not been remitted to the tax authority. How will that modality work? Probably let's wait and see in terms of if whether we're going to be having regulations and whether those are going to address the particular challenges. It is working across the other East African countries. Probably it might be about time that we see how that is going to be working in Tanzania. Again, I see there is a question from Elizabeth, who is also asking in terms of the increase in the final withholding tax rate on payments for technical and management services rendered in the extractive sector. For this, probably we do expect to see in terms of which specific section of the Act that the minister is proposing to amend. Why is that? Because there are two different provisions. One is one that is specific to service providers, technical service providers in the extractive industry, of which the 5% is the final withholding tax payment, and that they don't pay any additional taxes. But at the same time, we also have an additional provision which talks about fees and professional services fees and commissions and whatever, which are charging the 5%, which is a non-final withholding tax payment. So the guidance probably in terms of whether it's going to be a final withholding or non-final withholding, then definitely is going to be coming specific in terms of the specific section of the Act that the Commissioner is going to be intending to amend. Probably I can stop there and ask my colleagues to respond in terms of the service levy. Benedict, if you can take that.
Yes, thank you, Sam, for those comprehensive responses. So in terms of seat service levy, I think the question somehow confuses the seat service levy with the hotel levy. So these are two distinct levies. So seat service levy is imposed on corporate entities who are now required to pay. It was a varying rate of 0.3% of their gross turnover. But now the government has downward revised this rate from 0.3% of the gross turnover to 0.25%. So that means seat service levy, specifically from July 2025, it will be 0.25% of the gross turnover. Now coming to hotel levy, so previously this was 10% of the gross turnover, which was also applicable to those in the hospitality industry. But now the government has revised it downward to 2%. And I think, as I said earlier, the essence is just to ensure there is a prevalence of cost relief to those, to the business fraternity, and then bolster the investment and business environment in the country. Thank you.
Thank you, Benedict. We also have another question on retained earnings. I think, Sabato, you can come in and comment about it. Amos is asking whether this would result to double taxation.
Thanks, Fiona. I think we have addressed that already. And yes, I would agree, but I think let's wait for the wording of the law. We can give more details then.
Thank you, Sabato, for your comments. I think we also have another question on the chat. We asked whether enforcement of mandatory insurance to non-SADC or EAC foreigners might be handled for short-term visitors or business travelers. Now, would Benedict like to take that?
Can you please repeat the question? Sorry.
So the question is, how will the enforcement of mandatory insurance to non-SADC or EAC foreigners might be handled for short-term visitors or business travelers?
Yeah, so I think first of all, to put clarity, the travel insurance for foreigners, as I've said, will exclude those coming from EAC and SADC. So that means any foreign person who is a resident in the EAC partner state or SADC partner state will not be susceptible to the travel insurance. But now, in terms of those foreigners, apart from EAC and SADC, then the wording in terms of what has been proposed in the budget is first to limit the applicability of that travel insurance for only 92 days. And I think the budget has specifically stated that they are trying to borrow a leaf specifically in what is happening from Zanzibar. So I think the expectation, even though we expect more clarity will be out once the finance bill is rolled out, but for now we anticipate a similar modality to what is prevailing in Zanzibar. So that means it will be more or similar to what is actually now happening in Zanzibar in terms of execution of the same. But once the finance bill will be rolled out, I think more clarity on the issue will be out.
Yeah, probably, Cecilia, to add more to Benedict's comment. I think for me, looking at the proposition that it's an introduction, and we already have it in Zanzibar, and then I think that for me, what I foresee is that the implementation will be more or less at the point of entry, whether you're entering through the airports, whether you're entering through the ports, or through the borders. That will be a point where the immigration or the government will be able to tell that we are having a visitor. I think in terms of the distinction, whether it's an East African community or SADC, I think the passports will play a key role here to determine who is eligible and who is not. And definitely, if it's a non-resident that comes to the country, if it's either for leisure or for business, definitely there are different permits and different visa requirements for you to be able to comply with, for you to be able to enter the country. So the expectation here will be the point of entry, whether through the airports, whether through the port or through the border, then definitely the responsible officers or the responsible person in charge to make that enforcement will be able to do. Same way that when you have foreigners who are coming for business, should they pay their visa either at the port or before entry? So then that is definitely something that I'll expect to be the way to be able to track this. But let's wait and see what the finance bill will have to clarify in terms of the procedure for that.
Thank you, Sam, for further clarity on that insurance question. I would like now to introduce and invite our tax partner, Fabiola Sebuyoya, who will also be taking a question and answering one of the participants' question on when do we expect all these laws to be finalized and changes to be implemented. Fabiola, you're welcome.
Thank you, Cecilia. Good morning, everyone. Yeah, in relation to when the proposed changes become effective, so between now and 30th June, we expect that the minister will issue the finance bill, which is a draft act, and then the bill will call for various engagements with the Parliamentary Budget Committee for proposals to be made and any changes to be effected before 30th June. And then the Act, we expect for it to be issued by 30th June, but then all the changes that have been passed in the law through the Act become effective from 1 July 2025. So we only have about 2 weeks before the proposed changes become law and implementable. Thank you.
Thank you. Thank you, Fabiola. I think looking at our time, we would like to keep taking these questions on further discussions separately. Our communications will be shared with all the participants so we can take these discussions in more depth to navigate them in greater detail separately. But in the meantime, would like to welcome our panelists to just say a word as we wrap up this webinar before we get to our closing remarks. So for that, would like to start with Dr. Mari. Just some final words before we go.
Yes, thank you. I think what I'm seeing and what I've heard even from the discussion here is a mix of, I think, mixed feeling about the budget. While there are efforts to try to improve the business environment, there are also introduction of fiscal measures that may be counterproductive in terms of discouraging investment, and specifically this issue of deemed tax on deemed dividend, because if retained earnings are not distributed within 6 months and you introduce withholding tax, we are actually deeming that those are dividends. And yet companies grow both out of unretained earnings and external finance. And there are companies which choose to continue to reinvest before they begin to issue dividends. So this is something that the government might wish to reconsider. So yes, but otherwise, I think the projections for growth is relatively good. But in the context of targets to achieve a high middle income status economy in the next 25 years, I think these growth rates needs to be accelerated. We need much higher growth rate, if possible, to the double digit to be able to achieve what we anticipate. Thank you.
Thank you, Dr. Mari. It's good to hear you tell us that we can expect positive growth, because that's good news to every person who is looking to invest and to grow the economy. So next up, would like to welcome Glory for any final remarks.
Thank you. So for me, my request is that to support investment I think we need to relook on the AT applicability of AMCs, meaning that for the business that have regulated margin, the tax base should be the margin, and this is the best approach that we have seen the countries like Togo, Congo, and Cameroon taking that approach, compared to using the turnover, which I think it's giving a heavy tax burden to OMCs whose the price is heavily regulated, and no one can sell above the cap price that has been set by regulator. So that is my request for KPMG to push back this item to see how best we can support the investors in this sector. Thank you.
Thank you, Glory, for that analysis. And to finalize the closing remarks from our panelists, we also welcome Derek to give us a few words. Derek, you're welcome.
overall very good budget. Can you hear me now?
Yes, we can hear you, Derek.
Thank you, thank you. So I was saying, I think, referring to what the doctor has mentioned, overall very good budget. I think the focus areas, the consistency from, the budgets we have seen for the past 3-4 years, you still see the consistency. I think the key projects which, the government has been working on, there's still a lot of investment going in those specific areas as well. I think, as he has mentioned, the introduction of the 10% withholding tax on 10 earnings will definitely have a significant impact on the banking industry, and I think we do agree that the banking industry really drives the investment in the economy. So definitely, if you have some few tax policies which really impacts the capital growth, that also curtails the growth of the banking industry. So I'm hoping again, as he has mentioned, perhaps the government to reconsider this one. But again, as well, there are still some few other areas, as I mentioned earlier, especially around thin capitalization, which, came in last year. Several banks received some of the significant bills on the same, and there have been several discussions. So we are hoping as well to engage the government and then perhaps to see some changes on those specific areas. But otherwise, I think it's a very positive budget, and looking forward to supporting the business community and most of our clients on this call really to grow next year. So thank you so much.
Thank you, Derek. And I think one of the things you've mentioned is the proposed changes for the retained earnings, the withholding tax on retained earnings. That's one of the things that is touching a lot of taxpayers. A lot of questions are still on that item, and we're looking as it progresses and finalizes, there will be more light towards whether it's going to be implemented, and if so, how is it going to be implemented. And with that, I would like to now welcome Fabiola again, our partner, to give us the closing remarks for this webinar. Fabiola, you're very welcome.
Yes, thank you, Ceci. I think we've had very fruitful engagements during this session. And as we've noted from various contributions, the key objective of the government remains that they're looking into continuing to promote investment and trade in the country. And we've seen significant progress on this area over the recent past, such as the promotion of fiscal and non-fiscal incentives. For instance, we've had the newly introduced Investment and Special Economic Zone Act, which looks at achieving a smooth operation or application of various incentives and how the government can promote investment in the country. But I do believe that achieving this goal goes beyond offering traditional incentives. And so looking ahead, there seems to be a scope for adopting more investor-friendly policies to achieve the growth targets that we are setting for ourselves as a country. Considering the budget speech, as we have contributed, we await to see how the proposed changes will achieve this objective to grow the investment and the trade levels in the country. I would like to thank you all very much for joining us today, but special thanks to our guests and panelists, Dr. Mari, Dr. Melchiori, Derek, and Glory. We appreciate your insightful contributions, but also to thank the entire KPMG team who have worked effortlessly to make this session a success. We will continue to provide updates on the budget, the Finance Bill, and the Finance Act. So continue engaging with us through our various social media platforms or following our podcast series and publications. But also feel free to reach out to your usual contact at KPMG in case of any queries or assistance. Thanks a lot, and I wish you a good day.
Thank you very much. have a good day to you, KPMG, and also all the participants. Thank you very much.
Thank you.
Thank you. Bye.
Thank you.
Thank you, everybody. So this marks the end of our webinar today. You have a good weekend, and thank you for being with us.
Thank you. Thank you.